Hey guys, it's Jeff. Mike's actually on vacation, spring break with his kids this week, so he's not in the office, but everybody else is here. We're all here. Everybody at ECA is here. So if you have any questions, it's business as usual. Just feel free to give any of us a call. As you're all probably aware, the DOL rule was set to go into effect, I think it was next Monday. But we haven't talked about it as much, really for a couple of reasons. Number one, you've got the 21-point checklist, so in a lot of ways you're already covered, and ECA in the background has been working diligently to prepare for the DOL, and there's a lot of uncertainty about what's going on. So actually, Joe Spillman, the president of ECA, is with us this morning, and he's going to talk a little bit about what's going on with DOL and kind of where we are and what to expect. So thanks for coming on, Joe.
No problem. Thank you, Jeff, for the intro. And my goal was, and Jeff will, Missy will laugh about this, I wrote down that I want to talk to you guys today about what we know for sure. And, I got one sentence written down and then I stopped because that's kind of all we know for sure is that the government has asked the Department of Labor to implement a new rule called the fiduciary rule, and that's really all we know for sure. However, there's some other stuff that I think has gotten along far enough that we should start being cautious of and start thinking about and planning on our business that is most likely going to affect what you guys do on a daily basis. So, let's talk about kind of where we are at today. Most prevalent news that everyone is talking about is that we got a 60-day delay. In fact, if you pay attention to a lot of the news trades out there online, most people are reporting that we got the delay and everyone's excited. That's not true. The truth of the matter is the Department of Labor did ask for the delay, which is kind of a win. It's the first time the Department of Labor has done anything that, frankly, we've liked. The problem with that is they can't really grant the delay on their own. They have to go to another government agency, which I had to write down. It's called the Office of Budget and Management. And the Office of Budget and Management has the briefing where the Department of Labor is asking for a delay of 60 days. And the reason they're asking for the delay, frankly, is because they need more time to do what they've been asked to do by President Trump, which is review the rule and find out what the economic impact is of the rule and whether or not implementing the rule is going to hurt investors get the ability to get investment advice from advisors. And I think most of us on the call would agree that if this rule gets fully implemented in its original form, there are going to be a lot of advisors that are not going to want to work with clients that have small accounts because the rule is just too onerous, there's too much liability, there's too much risk to work with a client if you can't frankly make any money doing it. So that's one of the biggest concerns that the government has out there is making sure that they don't take away advice from consumers. So with that being said, last week was a very interesting week for me because I regularly on a weekly basis talk with 10 different carriers, attorneys, and typically the chief marketing officers, and again they grab their attorneys on the line with them and talk through where they're at and what they're doing. Early on last week, most of the carriers were saying that it was business as usual. April 10th comes in, any qualified funds that come in on a fixed index annuity that are not accompanied by a financial institution's approval, sign-off, review, whatever you want to call it, they were going to return that or call that business not in good order. It varied on which carrier. I'll give you just one easy example. Allianz said that if they know who your financial institution is, they're okay. If you don't tell them who your financial institution is, they're going to hold the business as not in good order and give you 48 hours to report back to them on who your financial institution is. If you tell them, then it would be business as usual. Other carriers were going to return the business and tell you you had to have an approval of a financial institution, and the financial institution needed to review the business before they would even take it. Other carriers, like Great American as an example, said they're going to treat it business as usual day one. The business comes in, they're going to just process it like normal because they expected that the delay is going to happen. And then I would say at the end of last week, just about every carrier went ahead and said they're going to pretend like we got the 60-day delay. even though, quite frankly, we don't have the 60-day delay yet, but there's really no reason to think we wouldn't get the 60-day delay. The only news article I read that talked about us potentially not getting the 60-day delay was a writer concerned that the people that are for this rule would sue the Department of Labor for giving the 60-day delay. And their rationale behind it is that they've spent lots of time and money getting prepared for the rule, and that the delay would economically impact them to the negative because they've done so much time and expense on preparing for the rule. So even if we do formally get the delay, this person is expecting that there's going to be lawsuits filed against the Department of Labor for giving the delay, which potentially could reverse or even shorten the delay. Again, it's very unlikely and very, just very unlikely that that part is going to happen. So what we, I think, need to start assuming now is that the rule is going to eventually go into effect. For a long period of time, we were acting like the rule was not going to go into effect. It was going to get delayed and then delayed some more and then eventually gone away. That could still happen, but what I don't think we want to do is expect that that's going to happen and then get caught later with our pants down, not prepared for the rule. So what I can tell you that ECA Marketing has done is we filed with the state of Minnesota to become a registered investment advisory firm. Now, the intent of that registered investment advisory firm is so we can become a financial institution, so we can help producers that are writing fixed index annuities do it in a way that meets the requirements of the Department of Labor's fiduciary rule. This first year is an easy year as compared to what next year is going to look like. And the reason for that is we don't have to have levelized commissions this year, and we don't have to have a best interest contract signed between every one of your clients and the financial institutions of the world. So to comply with the rule in the first year, what we need to make sure we're doing as producers is proving our work, showing our work. So you remember back in math class when we had to start doing long division or two-digit multiplication problems, some of us, and not me, but some of you on the phone probably in this business obviously, were smart enough to just do the math in your head. And some of the teachers were okay with that, but I would say most of them were not. They wanted you to show it and work it out so they could prove that you knew how to do what you were doing. A good way to think about it is if you're selling a fixed index annuity going forward, you're going to want to show why you chose the product you chose and why that product sale is suitable for that consumer. So we have teamed up with multiple companies and reviewed multiple different softwares to come up with a risk analyzation score or software that will help you determine and prove that that client is risk adverse and that a fixed index annuity is a suitable sale for that client. The next step is when you do figure out that the client is suitable for a fixed index annuity, which one is suitable for that consumer? Well, in today's world, I would say that most of this picking is done between the marketer at ECA, Jeff, Jerry, or Jeb, or the guys over at 5Q, I'm sure, helping a lot with that as well. Pick which product is best based on highest caps, highest crediting methods, historical performance of the products. If it's an income rider sale, that's pretty simple. You run it through an income rider comparison software. You pick the product and you send it in. The biggest thing with this rule is the financial institutions, which we're going to be. You may or may not want to use us as your financial institution, and I'll get into that in just one more second here. We're going to want to just see your work and why you chose the product you chose. That's all really, really easy if commission's not a problem, which in the first year it's not. In the second year, if you submit a case to us that happens to be the highest commission product available in the industry, then you're really going to have to prove your work, because you're going to have to prove that that sale was the best for your client, irregardless of your commissions. And of course, some financial institutions are going to be suspect of that either way. So the weird part is there are many occasions where the highest commission product is the best fit for that client. And I can tell you at ECA, we're going to approve that sale as long as you can justify and show us why it is the best fit for the client. We do expect the carriers to start changing their products some, specifically once 2018, January of 2018 starts to come around. Most of the carriers out there that have what are being deemed as outliers as far as commissions are concerned are talking about rebuilding their products to pay a little bit less commissions to get in line with industry kind of standards. What is industry kind of standards? Just to throw that out to you guys quick, it's probably right around 6 to 7%. So what you'll probably expect to see coming in 2018 is most of the products that are available for you to sell are going to be right in that kind of commission range. Anything outside of that commission range, some financial institutions are going to have a hard time approving it. Some are going to be okay as long as you can, on paper justify why you picked that product that you did pick. So one thing we know for sure is if the rule goes into effect, you as a producer are going to have a financial institution approve all qualified fixed index annuity sales that you make. Who can be your financial institution? And this is one thing that I think you guys all should be doing a little bit of work on today, is figuring out who your financial institution is. If you're a securities rep with a registered broker-dealer, it's probably going to be your broker-dealer. Most broker-dealers have already put their rules out there, or at least they know what their rules are and maybe haven't fully shared those with their producers yet. If you're a registered rep, registered with a RIA firm, or you are your own RIA firm, those are two, of course, different things. If you're registered under an RIA firm, it's a possibility that that RIA firm would be a fiduciary and would be your financial institution. I have talked to a lot of RIA firms. Some are going to do it, some are not going to do it. The ones that are not going to do it are basically saying, why would I take on that liability when all I really want to do is help collect assets under management? I don't really want to sell fixed index annuities. It's just not in their wheelhouse. They'd prefer to let somebody else do that for them. ECA Marketing fully intends to offer that service to those advisors. There may be some selling agreements required between your RIA firm and us, meaning that your RIA firm would maybe have to approve and allow us to sign as your financial institution for your fixed index annuity sales. I would suspect that we're going to want to start having some conversations with whoever your RIA firm is to get that stuff going. If you are your own RIA firm, which I suspect a few of you are, you've registered with the states that you're in, or maybe even on a federal level to become your own RIA firm. If you plan on being your own financial institution and approving your own fixed index annuity sales and signing your own best interest contracts with your firm, you probably need to hire a consultant firm or a law firm to help you get prepared so you can follow the rules and not put yourself in harm's way of a potential lawsuit in the future. Again, ECA fully plans on offering that service to you guys and make it available to you guys. If you're an insurance-only rep and you're selling fixed index annuities with a qualified account, you need to find a financial institution, and again, we hope it's us, but that's not a requirement. There could be other financial institutions out there that would offer this service to you for a fee. That fee would come in the form of dollars, and I can give you guys an example of one firm that's been very public, which I appreciate because most are trying to keep this thing a secret today. There's a RIA firm called Hoarder Investments. I'm sure some of you have heard of their name. They're offering to be a financial institution for insurance-only reps, and they are charging via a PayPal account 26 basis points of the asset value on anything less than $150,000, and they're charging 13 basis points for anything north of $150,000. There's some weird parts to that. The biggest one being you pay that whether the client actually buys the annuity or not. You're paying for the review. So if you send a case to Hoarder and they review it for fiduciary approval, you're paying via PayPal that 26 or 13 basis points, irregardless of if the sale happens or not. They've also rolled out a few other rules. They want to see the risk tolerance score. They want to see why you picked the product that you did pick, and then they'll give you that approval or that decline. That'll be challenging because we're not used to having to ask permission from financial institutions to make these fixed index annuity sales. So in other words, there are going to be multiple financial institutions out there for you guys to choose from, and I think that if you haven't already started to consider who you're going to use, you need to start thinking about that. Of course, commercial for ECA Marketing, this is what we do. We sell fixed index annuities for a living, as well as other fixed annuities and life insurance. We know the market, we know the business, so I think we're going to be really good at being a financial institution for insurance-only reps that sell fixed index annuities. So stay tuned. We're going to continue to roll out what our plans look like. One thing I know today is that we're going to have some kind of a risk tolerance workup done. There's tons of online softwares available out there that allow you to do that. I think 5Q has some tools maybe already built or partially built to help you do that. We're going to have it available both in a paper form where you just go through a questionnaire with a client to determine their risk tolerance score. And that's going to be enough for us. We're not going to get real in-depth. We're not going to require you to pay for some expensive software. If you want to use some expensive software, of course, we'll accept those, but we're going to try and make that piece of it as simple as possible. The other piece is the analyzation of product. We believe that we're the best at doing that. If you give us a I got a guy call, right? So if you guys call up one of the marketers and you say, hey, I got a guy with 150,000 looking for the highest guaranteed income rider in the business, we have already the softwares and tools that we can run the comparison quotes. We don't think today there is a tool that will do this perfect, except our marketers, meaning that there are some softwares out there that will allow you to compare side by side 10 different products, but those softwares don't know where the niches are. They don't know where the tricks are to make the product actually perform better. And just a quick example of that is there's products out there like with Lincoln that if you just take penalty-free withdrawals in the first couple years and allow that income value base to grow until the client hits an age bracket, it'll actually pay more than if you just run the comparison quote. Well, most softwares, I shouldn't say most, all softwares can't do that. They don't know the difference. So we're going to have our marketers provide 3 illustrations with every sale, and then you just got to show those to your client and then explain very quickly and briefly why you picked the product that you did pick, and we expect that to be a very simple process. One last piece to share on the financial institution. We do intend on growing our financial institution as a asset accumulator, as an RIA firm. We're going to have different investment models and platforms available for those of you considering getting your Series 65, or those of you that maybe have your 65 and aren't super excited about who you're working with today. Again, we think that we're going to do this in a very insurance-focused way that some of you may really enjoy. As compared to an investment philosophy, we have an insurance philosophy, insurance-based philosophy here at ECA. So the goal of that is probably 3rd or 4th quarter of this year that we would actually roll out what investment models would be available under that umbrella and how you guys could join us for that type of business as well. That was kind of what I wanted to just start with there. Jeff, did you have any other specifics that you wanted me to kind of address on this call?
No, I think the only other question that's come up, and I'll kind of summarize in a second here, is do you have any idea when Office of Management and Budget would know whether or not, when they would officially grant the delay? Is that something we can expect this week, or any ideas?
I was told numerous times that we are to expect an answer either last Friday or today.
Okay, that's great.
I'm sorry,
that's the only question.
Good answer. We can't get good answers, unfortunately.
Right. No, I understand. So, guys, let me just kind of, if I can, and Joe, you can correct me if I'm wrong, kind of summarize. I think one of the things that not a lot's going to change this year, except that if you don't know who your financial institution is, you need to figure that out here within the next 60 to 90 days. One of the things, I think Joe's being kind of polite, but I'll be more obvious about it, is that ECA can be your financial institution. And while you'll have a lot of choices, hopefully, and I would encourage you to pick them. They're very insurance friendly, they're very cost friendly, they have a lot of expertise, they're expanding their the kinds of things that they can do, from just insurance to assets under management, to help everybody in any way that you're licensed to get that financial institution requirement out of the way. So I would say pick them. They have the marketers, they have the expertise, they have the experience, and they're willing to do it for you. And they've gone to a lot of trouble to be able to do this for you, so take advantage of it. So for you guys, you're all with ECA. I don't think you have anything to worry about. They are going to require you to turn in, it sounds like, a risk tolerance questionnaire. If you're securities licensed, you already do that anyway. If you're insurance-only licensed, that's something that you'll have to get used to doing, and at 5Q we'll show you how and where to do that in the process. They're going to give you comparison quotes so you can justify the product that you pick. The marketers are the best ones that are equipped to decide which 3 comparisons to show your client. And if you're with 5Q, we'll show you how to use those 3 and where to show those 3 and how to show them so that it's not a big deal. So any other questions for Joe? Or Joe, did you want to add anything?
That's all I had, Jeff.
Okay.
And I just wanted to pop in and mention also that we will be having Joe, thank you Joe for sharing all of that, but we will be having him come back a couple of times throughout this whole process so that he can keep updating us as he knows information and keep everyone up to speed on the newest that they've revealed. So.
Well, thanks, Joe. And
yeah,
I'll be
Jeff,
hearing from you more. Oh, go ahead.
Yeah. If any of the reps individually want to have a conversation with me about maybe what their broker dealers or their RAs are saying to them, or just individual concerns that they want to have a one-on-one conversation, the best way to reach me is just shoot me an email and I'll schedule a time with you. My email is very simple. It's just joe@ecamarketing.com, and I would welcome those phone calls anytime.
Yeah, and that brings up a good point. The guys at ECA are fully up to speed on this, so reach out to Joe or Jeff or Jerry or anybody with any questions or concerns that you have.
Thanks, guys. I appreciate your time.
Thanks, Joe.
Bye-bye.
All right. Yeah, kind of moving on. Again, I don't think this is anything to worry about. There is, I'm sure, going to be a delay, but we should plan that eventually at some point in the future, whenever that is, that the rule will eventually go into effect. Even if it's not this year, it'll be next. And we just need to know what to do going forward. Again, you guys are protected in the sense that you've got the 21-point checklist. Remember how you had to show your work? That's a big part of that. And we'll show you how to document all that and be in compliance and have that extra tool in your tool chest that nobody else has to kind of insulate themselves when this rule finally does go into effect. And again, ECA is really on top of things, and they'll continue to keep us up to speed with what's going on. And again, any questions, just direct them to Jeff and Jerry and Joe. It sounds like you can contact Joe directly via email, and they'll work with you. Today, let's talk about this 5-minute moneymaker. Again, if you're not receiving these, make sure that you're checking your junk or spam folders because there's really good information in these each and every week to help you close cases. That and the 5Q breakdown. You know, we're sending those out every Thursday too. And the intent of those is to give you a 5 to 10 minute tape that you can listen to and then practice. So it's not just that you listen to it for 5 or 10 minutes and forget it. It's that you listen to it for 5 to 10 minutes and think about how you can incorporate that into your meetings the following week to make them better. So if you're not getting those, call us and let's get you going on these, because I've talked to a lot of people who say these have helped them close cases either that day or the following week, that they just happen to be timely. They're not timely for everybody, but somebody that's getting these is encountering a situation just like this, and they're able to get the answer and use what they learn here in their next meeting. So if you're not getting that, give us a call so we can get you on the list and make sure that you're getting them. Today, what I want to talk about is investment weighting. And every month we kind of take a deep dive into a specific topic, and so today's not really the deep dive. Today, I just kind of want to give you an overview on why you need to be good at investment weighting and what you can do when you run into clients at the extremes. And so what I mean by clients at the extremes, and I would say this is most of the clients that we meet with. A lot of times when we meet with people, they're either too far skewed to the equity side. They're overweighted on the equity side. That's a very typical person that we would meet with. Or occasionally we run into people who are too far skewed on the principal preservation side. That would be somebody who comes in and they have all cash, or 80% of what they have is cash. So investment weighting is really the key to getting those people to agree that being on the tails of a bell curve really isn't ideal. It's not where they want to be, and gets them thinking about making changes. So Imagine being in a meeting with a client where you're not really being pushed by their agenda, but instead you're being pulled forward toward an endpoint that you created and that you're excited about. And to be able to do that, you have to begin with the end in mind. If you've ever seen that book by Stephen Covey, it was called The 7 Habits of Highly Effective People. This was habit number 2. Begin with the end in mind. Because when you begin with the end in mind, what you have in a meeting is a sense of purpose. And you also have a sense of direction. And that sense of direction is really important when clients start throwing you curveballs. When the unexpected comes your way, and the unexpected always comes your way, this is a long meeting, guys. This is 90 minutes to 2.5 hours long. They're not going to say everything according to script. There are going to be times when they ask you a question or they try and pull you off in a different direction, and it's tough to know how to get back on track if you're just kind of freewheeling it. But if you begin with the end in mind, it's easy to get back on track. And when you begin with the end in mind, you can build a presentation where it seems like you can see the future. And that impresses people. That gives them a lot of confidence in you and makes them think, you know what, this is the guy that we should be working with. So I'm going to start by asking you guys some questions. I want to do kind of just that 10,000-foot overview of the 5Q system and kind of see where we're at. We start with marketing, and the idea of marketing is it's going to get people to meet with us one-on-one, whether you're doing the eye-to-eye and sending that out and people are calling to make appointments to come and see you, or whether you're doing some sort of a presentation, a seminar to get people to come and see you, whether you're sending out the drip pieces or you're getting referrals, all of that's marketing. It's all designed to get people to meet with you one-on-one in your office. So once you got somebody to come to your office and meet with you one-on-one, the first thing we do is the agreement meeting. So let me throw this question out there. What's the purpose of the agreement meeting? Why do I do the agreement meeting? Let's see some answers. What am I trying to get out of the agreement meeting? It's simple. It's well, I'm getting a lot of answers that say the next meeting. And no, that's not what I'm trying to get out of the agreement meeting. If all I wanted was a next meeting, I could just say, hey, thanks for coming in. Hey guys, if you go to a next meeting, you get a $100 gift card at that meeting for letting me do a portfolio review. You want a $100 gift card? And I could get people that way to go to the next meeting. So it's not really that. I do a little bit more than that. So yeah, part of it, I'm getting the answer, remove fear or anxiety a little bit. I would agree with that. Have them agree to bring their stuff in. I would agree with that. Really what I'm trying to do is I spend the first, call the agreement meeting 30 minutes long. It can run a little longer. But most time it's going to be in that 30 to 35 minute range. So how is that 30 to 35 minutes spent? Well, it's spent doing 2 things. So that's why the meeting is simple. There's only 2 parts. 1, I want to explain what I do and how I work. Here's what I do. Here's how it works. Does that sound reasonable to you? So the first 10 minutes is really that. That explanation of what I do and how I work kind of depends on where they came from. If they came from an eye-to-eye, you're all familiar with explaining, hey, what I do is I look for benefits through these 21 different data points to see if we can find things that maybe you're eligible for that you're not receiving. That's what I do. How it works is if you agree to come back for another meeting and let me run that analysis for you, I'll give you the gift card and the report, and then you can decide what you want to do. If they are coming from a seminar, it might be, hey, what I do is I kind of look at the little things that people, because we can all see the big things coming, but I look at the little things to see if anything can kind of jump out of the grass and bite you in the butt, kind of like we talked about at the seminar. And so what I do is a 21-point checklist. If you'd like to do the 21-point checklist, and here's why I think it might be of benefit to you, then you know, we'll kind of go forward. Is that something that you want to do? Either way, that first 10 minutes is just me explaining what I do, how it works, and getting their agreement that, yeah, that's pretty much what I thought. I'm in. That's part one. Part two, gather data, gather facts, go through the fact find. Takes about 20 minutes. You've all seen the fact find form. It's short. It's simple. Takes about 20-25 minutes to do. But I have to have those facts in order to create the checklist. I can't go into the software and answer the questions of steps 1, 2, 3, and 6 without that fact find. So that's the purpose of that meeting. Get them to buy into what I do and how I work, and then answer my questions and give me their statements. If you have questions about that, give me a call and we can go more into that. But that's really the purpose of that first meeting. Gather information. And I'm going to take that information, plug it into the 21-point checklist, and create the custom proposal. So now that I've got the custom proposal, what's the purpose of the proposal? What am I trying to get them to see or to acknowledge at the 21-point checklist meeting? Let's see some answers to that. What am I trying to do with the 21-point checklist? Yep, you're all getting it. Get them to see that their advisor is looking out for himself and not them. And if they think their advisor is looking out for himself and not them, what are they going to want to do? Change advisors, move. So that's key. That's why we start by learning that meeting first. Because if you can get somebody to say, I don't want to work with that guy anymore, you're 90% of the way there. And once they come to the conclusion that they don't want to work with that guy anymore, they're ready to see some ideas. I mean, ideally, the end of the second meeting, the 21-point checklist meeting, would end kind of like this. Hey, do you guys know more than you did before we sat down and talked? And they'd say, yeah, we know a lot more than we did. We've learned a lot today. Is this where you want to be, or do you want to look at changes? Oh, no, I mean, we want to look at changes. Well, how would I fit into that? You want me to be hands-on as you're looking at those changes, or is this more of an academic exercise? Well, I mean, no. I mean, we're hoping that you could maybe give us some ideas. I mean, we don't know what you're suggesting. I mean, what would you think we should do? What would you recommend? And that's when I say, oh, no, absolutely. I'd be happy to recommend things. So what's a good time next week that we can get together for maybe, say, an hour and look at some different options for you? And I set that appointment right there. So the purpose of the agreement meeting is to get them to buy into the process and give me the information that I need to create the checklist. The purpose of the checklist meeting is to get them to say, I hate my guy. I don't want to work with him anymore. And at that point, they're going to say, so now that we're homeless, I mean, what should we do? What are your thoughts? And I can say, well, my thoughts are, let me put pencil to paper and figure out what some good options are there out there for you, and let's set an appointment for next week to kind of go through them together. When they come back the following week to look at options, I'm going to begin with the review of the 21-point checklist. Why do I begin with the review? What's the purpose of the review? Yeah, Wade's got it. Pull off the scabs so that they relive the pain. Make sure they still hate him. That's exactly right. Those are all good answers. Because it's human nature. If I did the 21-point checklist meeting right, they leave thinking that guy is a jerk. He's only looking out for himself, not me. But it's a week between meetings, and so what happens during that week? They get angry, or they calm down a little bit? Yeah, they calm down a little bit. And some of them calm down a lot. Some people calm down a little. Some people calm down a lot. But everybody calms down. And so I have to start the next meeting by reminding them or letting them remind themselves why they were angry, to work them back up into that mindset of, I don't want to be with, now I remember why I remember now why I was mad. I remember now why I don't want to be with him. That's how this implementation meeting starts, with them saying, I don't want to be with him. Basically, I go through these 21 things and I'm just jogging their memory. Why did we say, what was the problem with the power of attorney? Well, it wasn't going to work if I was sick. Right, and again, what kind of a guy, what kind of an advisor wouldn't go through that with you? Well, not a very good one. What do we find out about the titling? Oh, that it's not titled correctly, right? And again, because it wasn't titled correctly, the company was going to be able to keep the money longer or shorter? No, longer. And the reason they did that or didn't alert you to that is why? Well, they wanted to, like I just said, they wanted to keep it longer. What's the problem with that? Well, they're just trying to make money off me when I'm dead. So I'm just reminding them of peeling back the scabs. I think somebody said it best. And then I'm going to end that little review with the same 3 questions. Again, do you know more about how things are working? Yes. Is this where you want to be? No. Again, you wanted me to be hands-on or more of an academic? No, I'm guessing that we're here to, I'm hoping you put together some options for us. No, I absolutely put together some options for you. So let's take a look at those. And when I start to show them options, I'm going to show them that the options that I've put together for them have 2 parts. Part 1 would be the growth option. And if you're insurance only licensed, you can call me and we can talk about what I do. I still talk about part 1, but in a very abbreviated way if I'm insurance only licensed. If I'm dual licensed, I talk about the growth option and I present it. Here's what I think you should do for growth. Here's why I like it. Here's why I think you should like it. What are your thoughts? And then the part 2 is the safe option. We didn't want all of our money in the market, so here's what I think you should do for the safe option. Here's how it works. Here's why I like it. Here's why I think you should like it. What do you want to do? But now, I'm not going to get into that. I'm not going to do a deep dive. If you have questions about that, when you're working on cases, a lot of times when you get to the implementation meeting, we'll talk in depth about this. But here's the thing that I want you to leave thinking. If I know that there are 2 parts, growth and safety, what do I need to get them to commit to in advance? In other words, beginning with the end in mind. If I knew in the 3rd meeting, the implementation meeting, that I was going to need them to agree that there have to be 2 parts to a portfolio, growth and safe, what do I need them to commit to before we even get to that 3rd meeting? Yeah, that there has to be 2 parts. I need them to tell me there needs to be 2 parts. I need them to tell me somewhere in that 21-point checklist meeting that, hey, you know what's, it's starting to dawn on me that I need both growth and safety. That's the power of beginning with the end in mind. I know at the 3rd meeting that I'm going to show them 2 parts. That means in the 2nd meeting, I need them to ask me, hey, can you show us a plan that has 2 parts? So how do I do that? Well, that's what investment weighting is all about. See, the implementation meeting is literally a piece of cake. It's probably one of the easiest meetings you'll ever have if they hate their guy and they have to rebalance. If they fit both of those criteria, you're on easy street. Now let me ask you this question. What if they agree that, yeah, we need to rebalance, but they don't hate their guy? What happens? They agree, yeah, we've got to rebalance, but we still like our guy. What's going to happen? They're going to go back to their guy. That's exactly, the money stays 0, exactly, you're all getting it. The key is they have to hate their guy, because if all they think is I need to change my portfolio, I don't hate my guy, but I do need to change my portfolio. Then they're going to go back to their guy and change their portfolio. Let me ask you the flip question. What if they hate their guy, but they don't need to rebalance? So they hate that guy, but they don't think they need to do anything with their portfolio. That's tough. I mean, it's better than the first situation, because then the worst case scenario is they're just going to move everything as is to you. How hard is it then to show them anything else? And that's where you can kind of get into trouble. Because if you try and talk them into something, if you try and talk them into rebalancing at the implementation meeting, you're just going to get shot down. And you start to run the risk that they're going to say, you know what, I'm not sure he gets me. I'm not sure, we just don't seem to be connecting, and it makes them wonder if you're the right guy. Now, if they really truly hate their guy, they're still going to kind of lean towards you and kind of move in your direction and move everything as is, but we don't need to be putting doubts in people's mind. So that's what I want to talk about today, because investment weighting is really the key to making sure that that doesn't happen. Think of investment weighting as like halftime in a big football game. It's halftime. So let me ask, if you're watching football and it's halftime, is the game decided? No, it's not decided. And I'm not going to tell you that if you do this well that everything's decided. But sometimes at halftime in a football game, I can have a pretty good idea of how things are going to turn out. If the score at halftime is 24-0, what am I probably thinking about the team that has 0? They're going to lose. Now, is it guaranteed that they're going to lose? No. Have I seen teams come from behind by that many points in the second half and win? Yeah, I've seen it. Does it happen a lot? No, it doesn't happen a lot. And so investment weighting is like halftime. If I botch it, if I don't do a good job and get them to say, geez, I need both growth and safety, well, that's like me being down 24-0. It means that in the second half, when I get to that third meeting, I'm going to have to be really, really good. If I botch it, does that mean I've lost? If I can't get them to agree they need both safety and growth, does that mean I've lost? No, it doesn't mean that I've lost. But how good do you have to be in the second half? How much room for error is there? I mean, it's tight. You can come back from 24-0, but can you go 3 and out a lot in the second half? No. Can you throw an interception? Probably not. Can you fumble the ball? Probably not. Can you settle for field goals? Probably not. Now, if the score is 24-24 going into halftime, can I go 3 and out? Yeah, I probably can. Can I throw an interception? Well, that's not ideal, but it's probably not going to kill me. Can I settle for some field goals? Yeah, and so if we're good at investment weighting, we're making sure that we're setting ourselves up for the second half being the implementation meeting that we know is going to come a week from that day. So I'm just trying to set myself up to have an easy solutions talk, to have an easy implementation meeting. And the way that I do that is to get them to hate their guy. The whole list is about that. But I also need to get them to say, hey, I need to see some growth options and I need to see some safety options. And that's what investment weighting is. It's that part where I get them to say, I hate my guy and I want to see some growth options and I want you to show me some safe options as well, because I need both. Now, if you can't get them to say that, like I said, that doesn't mean you're not going to get the deal. It just means that you don't have a lot of room for error, and that's stressful. That's tough, and I don't want to see anybody anybody in that situation. So let's talk about that. Let's talk about how do we get good at investment weighting. Well, the first thing is make sure you've done the tutorial. The tutorial's on the website, and if you haven't been through that tutorial and you haven't internalized that tutorial, I would really encourage you to do that. Make sure you've at least got that foundation of the tutorial, because I would tell you that that's going to probably solve most of your problems. It may not solve all of your problems, but it will solve most of your problems, and then you can talk to Mike or myself, and we'll get you on track to solve the rest of the problems. But everything starts with making sure you have this good foundation, and the way you get that good foundation is to make sure you've been through that tutorial, and you haven't just listened and watched it. You've experienced it, you've taped it yourself, you've practiced it, and you're confident in it. You're ready to do that in a meeting. And if you've already done that, you know that that investment weighting talk really has two parts, or I'm sorry, 4 parts. There are 4 parts to the investment weighting talk. They're not broken down that way. I'm breaking them down that way in this call so that you can kind of see what's maybe going on. Think of them as those little steps that they have to take. If I want them to say that they need both growth and safety, there's probably 4 things I need them to agree to along the way. I need them to agree to 4 things along the way. If they agree to these 4 things, they're going to tell you, I need to see some growth options and I need to see some safe options. So what are those 4 things? Well, the first one is, if you listen to the tutorial, you know that the first part of that is me talking about risk. That when it comes to money, no matter who you are, no matter how much money you have, no matter what your circumstance in life, when it comes to money, there are 2 risks. And what are they? Let's see some answers. What are the 2 risks to investing or saving or anything to do with money, no matter who you are? Yeah. Bruce says gain and loss. So what's the risk? Inflation. You guys are getting it. Inflation is one risk. The other is market volatility or losses. So the foundation is they would tell you, well, you have to be worried about inflation, because if you live too long, the spending power of your money could be eroded because the price of things goes up over time because of inflation. But the other risk is that you could lose your money, that the market could tank, and that you'd go backwards instead of forwards. So it's really important in the meeting that they acknowledge that there are 2 risks. And you would think that would be obvious, but I've listened to tapes where guys aren't so good at this meeting, and so people don't tell them that there are 2 risks. So there's 2 problems. One would be the advisors explaining that there are 2 risks. There's inflation, the price of things going up over time, but then there's losses, the idea that the market could go down. And have we seen that happen over the last several years? And what does the client say? Yep. And what do we know about yep? Can we agree that inflation is a problem? Yep. But is that our only risk, or are losses also something that we have to consider? Yep. If that's how you do it, that's no good, guys. That's no good. Because they're not expressing it, they're not internalizing it, they're not giving it their own voice. And this is just the beginning. If that's all they're saying here, I'm going to start to ratchet it up when we start talking about the other 3 things yet to talk about. And if I can't get them to agree to this, they're not going to agree to anything that comes after this. If all they're going to say is yep to this, yep is all they're going to say to everything that comes after this. So that's one problem that I see. You're doing a good job of explaining it. They're not explaining it at all, which means I think they get it. I'm just not, I think they agree, but there's nothing on the line. In the next 3 things, when we start putting things on the line, we're going to find out, well, they don't agree as much as you had thought. So don't make the mistake of not, they need to say inflation is a risk. That's in their words. They need to say the word inflation. They need to say the word losses are the other risk. That's the other side of the coin. They need to say the word losses. That's the first part of this. We then kind of talk about how those risks are age related. 5-year-olds, they're not worried about losses. Their parents pay for everything. But they are worried about inflation because, you know, when they get to be 25, things are going to cost a lot more than they do now. 95-year-olds, they're not worried about inflation. Heck, they don't even buy green bananas. But they are worried about losses because if they lose money, they don't have the time to make it back. That's why if you look at retirement communities, there's a bank on every corner. Because where do all the 95-year-old grandmas put their money? In the bank. So that's the first part. The second part is we need to get them to agree that there are consequences to being on either end of the bell curve. There's a consequence to being overweighted in equities. There's a consequence to being overweighted in capital or principal preservation. And they have to say that in their own words. I help them by giving them a story and then a comprehension test to see what they pulled from the story in their own words. But I have to get them to tell me what the consequence is. The consequence of being overweighted in equities is you could lose what you've worked all these years to gain in an instant. And if you've already got a comfortable retirement, do you really want to risk it knowing full well that it could go away if you don't take some sensible precautions? The story in the tutorial is about flipping a coin. Getting twice as much retirement if it's heads and losing the retirement that you have if it's tails. How many people want to take that bet? There's other stories that you can use, and I can give you other stories if you're having trouble with that one, but you have to get them to acknowledge that being overweighted in equities is a problem. You also have to have a story about being overweighted in safe for somebody who has all cash. Getting them to tell you that the problem with all cash is it doesn't earn enough to stay ahead of inflation. And so it's fine as long as from the time that I'm 60 to 65, it's probably not going to affect me, but as we get down the years, it could be a problem. They have to tell you the consequences. And the third part is being good at going through the formula. It's the formula that puts things in perspective. What I mean by the formula is this. They tell us that no, they're not that wild and crazy aggressive investor, nor are they that stick in the mud conservative investor. They're that guy in the middle, the moderate investor. But then we have to have a conversation about what does moderate mean to you? And here, let me put it in context. Here's what Nobel Prize winning economists would say. The heck, that's their opinion. Granted, it's their educated opinion, but it's not their money, it's whose money? It's yours. And so what's a good number for you? See, if they tell you there's two risks, if they tell you there's a consequence to doing what they're doing and they don't want to do it anymore, they're going to give you a number. Now, I'll tell you right now, with the Dow at 20,000, they're going to give you a number on the high end, not the low end. That's most people. I'll be pleasantly surprised when some people will tell me, oh no, I want to be down here. But a lot of people are going to say, well, I think I want to be closer to up here, which is fine, but they have to give me a number. Why? Because if I begin with the end in mind, I know that I'm going to need that number to know what to show them. If they tell me I want 45% of my money in growth and 55% in safe, then the next meeting is easy. I tell them, okay, well, you wanted me to show you two parts, growth and safety. You wanted 45% in growth, so here's what I think we should do with that money. You wanted 55% in safe, here's what I think we should do with that money. We need that number, but you're not going to get the number if you're not good at those other things. So make sure you're good at those other things. If you're not getting a number from clients, if they're wishy-washy about the number, call me or call Mike and let's hear a tape. And I'll tell you right now, you're not good at one of the first three parts. So you're either not good at getting them to acknowledge the two risks, or you're not good at getting them to tell you the consequences, or you're not good at getting them to see this formula in context. But we can get you good at those things. That's why you came on, because you wanted to know how to be good at those things, and that's where we can help you. Start with the tutorial, and let's work from there. The tutorials are going to really solve a lot of your problems, but don't worry if you do the tutorial and then you do it right with the client in a meeting and you still get blowback. If you get blowback, send in the tape. We'll show you what to do in that situation. Too often, guys call me about implementation meetings and I say, so what are you thinking? What are they looking for? Well, they're looking to put some, they agree that they need to be more moderate. Okay, perfect. What does moderate mean to them? Well, we didn't really talk about that, but I'm guessing it's probably, say, right in the middle there of that formula. That's where I'm thinking about starting. What's the problem with that? What's the problem with guessing at what the number is? I hear this a lot. I didn't get the number, but they're moderate. What's the problem with being vague? The problem with being vague is this. You're all kind of getting it. The problem with being vague is this. I can guess. I can guess. And my guess is going to be an educated guess because I just sat there with them at the agreement meeting for 35 minutes. I've gone through the disclosure meeting with them for 2 hours, so I've got 2.5 hours of background with them. My guess is going to be an educated guess. I know them pretty well. But if they didn't give me the number, my guess, which is going to be a good guess, is still just a guess. If it's not dead on, guess what they're going to say? Hey, that's a good number, but what would it be if it was a little bit higher? Ah, nuts. All right, come back next week and we'll look at a little bit higher. They come back next week. How about a little higher still? Nuts. Come back next week and we'll look at a little bit higher still. They come back next week. Oh, yeah, that's too high. I guess that might still be. How about a little bit lower and be? Oh no. How long are we drawing this out? We could take something that should take one meeting and stretch it into 4, all because we started with a good guess and now we're circling the bullseye until we hit it. If we know they're not going to be satisfied until we hit the bullseye, let's just ask them, what's the bullseye? I don't know what the bullseye is. Well, we know it'll be somewhere in this range. And really, it's a matter of personal preference. So what do you prefer? Well, I prefer 45, maybe even 50. Perfect. So if I came back with 50% in growth, 50% safe, is that the kind of thing that you'd be looking for? Yeah, that's what I'd be looking for. It's just a matter of asking. You need to know what they want for waiting. You need an out loud verbal commitment that they want to of what they want to see at the next meeting. And honestly, that question is sort of an implied close because it foreshadows another meeting. It's kind of an implicit commitment that they intend to come back. And I'll tell you, every time somebody's done this investment waiting well, they've always come back. They always want to see what you have. They know they need growth. They know they need safety. And they know you know exactly what they're looking for, so they're going to come back. The only thing is, if they don't hate their guy, they're going to take your ideas back to him. But if they hate their guy and they've given you this number, it's a done deal. It just needs to be interactive. See, I always tell people, nothing bad can come from a meeting that's interactive. If it's you guys having a conversation and putting your heads together and working it out together, nothing bad will ever happen when you do that. Nothing good can come from a meeting that's not interactive, so make sure your meetings are all interactive. Okay? So I know we've gone a little bit over time. If you have questions or if you have problems with investment weighting, give us a call. That's what we're here to do. The tutorial should give you a good foundation, and that should work most of the time. But if it doesn't work all of the time, that's not the end. Give us a call, send us the tape, we'll figure out what you need to do to tweak it, and we'll get you on the right track. Again, Mike's out of the office this week, but everybody else is here, so if you have questions about anything, or if you're working on something and you need some advice, give us a call. All right? Thanks, guys. We hope you all have a great week, and I'm sure we'll be talking to you guys, some of you at least, through the week, and we'll be in touch and talk to you soon. Thanks, guys.